Welcome. This presentation will define new growth, review how it is calculated, and how communities should track and report growth to the Division of Local Services. Proposition 2.5 allows a municipality an annual increase of 2.5% of the previous year's levy limit. In addition to the 2.5%, the levy limit can grow based on the valuation of new construction and other increases to the tax base that are not attributed to market value changes. This increase to the levy limit is called new growth. New growth is generated by the increase to the assessed value attributable to a physical change or a change in use to a property. New growth under this provision includes properties that have increased in assessed valuation since the prior year because of development or other changes, exempt real property returned to the tax roll, new personal property items added to businesses, and new subdivision parcels and condominium conversions. The purpose of realizing growth is to ensure the property values reflect full and fair cash value, and this increase in the levy helps to offset any additional municipal costs resulting from the growth. Let's look at an example of a property with an increase in assessed value attributable to a physical change. A home with an assessed value of $350,000 this year has a new wood deck constructed. This new wood deck increases the overall assessed value of the home to $362,000, resulting in $12,000 of new growth over last year. Later in the presentation, we will discuss how this $12,000 in growth is converted to an increase in community's levy limit. Here's an example of a change in use to a property that results in an increase in assessed value. A property owner splits one 5-acre lot into 5 1-acre lots. The original 5-acre lot would have had an assessed value of $275,000. The 5 1-acre lots now each have an assessed value of $100,000 and a total assessed value of $500,000. The new growth value for these new lots is $225,000. Here are two more examples of new growth value calculations. A property has an old single-car garage with an assessed value of $1,500 that is torn down and replaced with a new 2-car garage. The new garage has an assessed value of $10,000. The new growth value for the garage is $8,500. On the other hand, if the property hadn't had a garage and the same new garage was added, the entire $10,000 would be considered new growth value. It is the net increase in the assessed value caused by either a physical change or a change in use that can be included in the new growth calculation. Fluctuations annually occur in the real estate market and are reviewed by assessors so that assessments reflect fair cash value. Adjustments that result in assessed value increases due to market value are not eligible to be included in the new growth calculation. This year's assessment minus last year's assessment does not result in a clear indication of new growth value because it may include market value adjustments made between the 2 years. Also, the value of a building permit on a property is not an indication of new growth value. Reported cost of improvements does not necessarily equal value. It's the increase to the assessed value that is the measure of new growth value. The new growth calculation is the product of a simple mathematical formula. New growth is calculated by multiplying the increase in the assessed valuation of qualifying property by the prior year's tax rate divided by 1,000. For example, if a community with a single tax rate had a total new growth assessed value of $6,100,450 for fiscal year 2021, and the fiscal year 2020 tax rate was $12.77 per thousand. The formula would be $6,100,450 times $12.77 divided by 1,000, which equals $77,903. The new growth amount of $77,903 is added to the levy limit base when calculating the current year's levy limit. The new growth is recognized within the class in which it is generated, either residential, commercial, or industrial. Reporting of new growth provides a community with an opportunity to increase its levy limit while helping to add budget flexibility in the future. The tax year for new growth is a 12-month period that runs from January 1st to December 31st of the previous year. Parcels with any increases in their current fiscal year, assessed valuation, over the prior fiscal year, due to any new buildings, additions, renovations, or other construction, qualify as current fiscal year tax base growth. Properties with physical changes or changes in use need to be tracked in the assessor's database. During the year, building permits are filed and reviewed, subdivision plans are recorded to divide or split lots and create new ones, and field reviews are conducted for cyclical inspections and for the inspection of sold properties. The properties that have undergone the physical changes or changes in use need to be flagged in the database as they are encountered over the course of the year. Chapter 653 of the Acts of 1989, which is now Section 2AA of Chapter 59 of the General Laws, is a local option that permits the accelerated assessment of new construction and improvements built between January 1st and June 30th of the current year. If adopted by a community, Chapter 653 allows the assessors to include some property changes and related new growth value up to June 30th of the current year. The result is 18 months of growth in the first year after the option is adopted. Under Chapter 653, only certain changes are allowed in the period from January 1st to June 30th. New buildings, additions, and buildings removed or demolished. Not allowed in the 6-month period from January 1st to June 30th are condo conversions, subdivided land, personal property, and tax-exempt return to the taxable. Personal property accounts of businesses located in a community can also be a source of new growth. Here are some examples of when personal property generates new growth. New business accounts, new equipment and items not previously taxed, new inventory, refurbished machinery, utility growth, and construction work in progress growth, referred to as QUIP. Omitted or revised values are reported on the LA 13A and DLS gateway to capture parcels that were not previously assessed in the prior fiscal year. When omitted or revised assessed values are reported from the previous year, there can sometimes be unreported growth included in those values. Column A on the form is automatically filled with the values reported on the omitted and revised form in Gateway. In column B, the assessor must manually enter the portion of the unassessed value from the previous tax year that would have been attributable to growth. Not all omitted or revised value is considered growth. If the additional value was simply omitted from the tax bill in error, but was previously taxed, then it would not be growth. In column C, the assessor must indicate any growth reported in the prior fiscal year that was permanently abated. The LA 13A calculates the amended new growth amount by multiplying the unreported new growth value from the prior year by the prior year tax rate divided by $1,000. The amended new growth is added to the prior year's levy limit before the calculation of the automatic 2.5% increase allowed by law. The LA 13A also calculates any growth that was permanently abated in the prior fiscal year. This reduction in the new growth value happens when a permanent abatement is granted to a property that contributed to the new growth value last year. For example, a new 2-car garage was originally assessed for $10,000 in the prior year, with $8,500 taken for new growth because it was recently added to the house. An abatement of $1,500 was granted because of square footage error, so that the current year assessed valuation will now be $8,500. In this case, the $1,500 growth reported in the prior year will need to be removed in the current year. The assessors report the $1,500 permanent abatement in column C on the LA 13A, which reduces the new growth amount. As mentioned earlier, properties with new growth need to be flagged in the assessor's database throughout the course of the tax year. New growth is an increase in assessed value from either a physical change or a change in use to the property. At the end of the tax year, the assessor reports the new growth values to the Division of Local Services on the LA 13 form in Gateway. On the LA 13, the assessor reports the number of prior year abatements in column A and the abatement values in column B. In column C, the assessor reports the total new growth valuations by use. The LA 13 automatically inserts the community's tax rates from the previous year in column D and calculates the new growth increase to the tax levy in column E. The total real and personal new growth amount automatically populates the levy limit sheet and becomes part of the current year's levy calculation. The assessor can add any important information about the new growth values reported on the LA 13 in the community comments section at the bottom of the form in Gateway. More importantly, the assessor must upload the new growth template, which details the substantiation for the growth, to the current document section of the LA 13 in Gateway. The New Growth Template is an Excel spreadsheet designed by the Bureau of Local Assessment that is completed by the assessor and uploaded to the LA13. The spreadsheet provides a list of each parcel that is contributed to the new growth value, the reason for the growth, and the new growth valuation. This template provides backup documentation for the summarized new growth values that are reported on the LA13 form. A copy of the New Growth Template and instructions on how to use it can be accessed on the Tax Rate tab landing page and gateway. For more information on this topic, please visit mass.gov/DLS for up-to-date legal guidance, opinions, and advisories regarding new growth. In addition, you will find contact information for the Division of Local Services, as well as additional municipal finance-related resources.